I'm Jake Cusack. I'm managing partner at CrossBoundary. We're a firm focused on bringing private capital into underserved markets. We have 8 offices in Africa and have been working there for about the last decade. And so excited for this opportunity. To my right, I have Ryan Wagner, head of infrastructure at CDC. My colleague, Marilia Martins, associate principal at CrossBoundary based in London, but having done significant work in Africa. Saad, Sheikh of TLG Capital. And virtually, we have Hubert Danso coming in from Johannesburg. Thanks for joining us. The bios are in the program, so I think we'll just get right into it. I think maybe as an opening question for everyone, what is the state of the infrastructure landscape? It's been a while since we've had the opportunity to be in person and talk about it. I think we've seen some real challenges in the private equity asset class and the withdrawal of some players from the market, challenging net returns for sort of private equity growth capital, perhaps a bit better picture in the infrastructure space. And then we're seeing this rush, relatively speaking, into venture capital, and it getting easier for venture-backed companies to raise capital. So curious, from all of your perspectives, what are you seeing? Obviously, the infrastructure gap remains. What's needed to close that gap? And maybe start with you, Ryan.
Yeah, sure. Thanks, Jake. Pleasure to be here. It's great to be at a live conference.
Yeah.
I think, over the past few years, we've seen a kind of a stark change in the infrastructure fund space as well as the broader landscape. And I think part of that has been this shift from kind of core infrastructure to other areas like venture capital, like further deepening into the renewable space. So I think we have started to see some shifts, especially within Africa, and especially on the fund side, managers becoming more specialized, more or deepening their skill sets a bit further into the market. I think returns, as you mentioned, have been an issue, and we have sort of seen a retreat from some commercial investors or global investors into African infrastructure. Hopefully that's just a temporary thing, and hopefully they do return, and some things like climate will attract them. I think we're seeing quite a movement into the climate space from a lot of investors. I think the other conference in the UK that's going on right now is probably talking a lot about this, and hopefully we see more capital from climate investors going into Africa.
Great. Marilia?
I think I broadly agree with Ryan, and I think if we take a look at kind of the global funding, especially when you look at SDG in the SDG space. I mean, just to bring a few numbers in, 20% of the global assets of the $379 trillion in global assets are in emerging markets only. So if you move 1.1% of the additional number, you're able to close that funding gap, and you're seeing within the ESG space a boom as well in the growth of that capital supply. So from 2020 to 2021, you've grown that, especially in the public market space, over 50%. But then if you zoom into Africa, then the continent only represents a very tiny portion. So 2% of all the cumulative green bond issuance from 2012 to 2019 is African based, and you only have 24 issuers across the entire continent. But as Olusola said in his opening remarks, you are seeing sort of a record fundraising in the private side as well. So 10 new vehicles in Africa and new capital flowing in. So I'm not. It might be a bit controversial, but I'm not sure if it's really kind of a question of supply of capital, or if it is a question of really having the deal flow to absorb that. And so how do you bring new green projects into, and I'm focusing on green infrastructure, but how do you bring that in and make those projects actually ready to be viable, right? So you have the pipeline, but is that pipeline ready to absorb that capital flowing in?
Yeah, I would agree with that. Saad?
Yeah, no, it's a huge landscape. Firstly, pleasure to be here and in person. Huge landscape and something that we've seen getting more and more entrenched in. So I represent a private credit fund, so might be slightly outnumbered here, but what we're seeing is the growth of credit on the continent as an asset class, really supporting all types of investment opportunities, including the venture side, including late stage, etc. So wherever you see an investment opportunity, there is an angle of credit there. So the way that I'll spin this question, Jake, if you allow me, is the angle that credit brings, but also the opportunity that we've identified through local currency credit plays, focused on infrastructure. For example, in Nigeria, and InfraCredit was mentioned, I think those organizations are great, but sometimes they tend to crowd out private capital. So I think there's an opportunity for both to work together. I've worked with InfraCredit on a number of occasions, and they've come back to me and said, well, can you lend in 9% in Naira? And obviously my jaw would drop, right? 9% in Naira is negative yield in dollars. How do I do that when my return profile is double digits? So you know, there needs to be that comfort between these multilateral organizations and private capital to work together. That collaboration hasn't kicked in yet. They're individual silos, but I think that's just the nature of the market. It's a question of maturity. So I do think that what we're doing in healthcare through whether infrastructure of manufacturing or distribution or retail, whether infrastructure in terms of rural telephony, which was also mentioned that we're looking at, all of those infrastructure projects require an element of credit, but well thought through credit. An element of local currency, an element of dollar denominated. So all of that kind of works really well. We've, for example, supported our infrastructure plays with technical assistance as well to provide solar energy or to provide other infrastructure opportunities that the DFI support with. Like, for example, Ryan, I'm sure will talk about it, because we took technical assistance from the CDC and from Sweat Fund to put solar panels in 2 of our healthcare clinics. So I think it's a meeting of minds and kind of bringing all the players in the market together to broaden the pie. I think that's what needs to happen. And a great point that you mentioned, that I think there is that question, are there enough fundable projects out there, right? And I think there are, they're just not in the fore. So we all need to kind of collaborate and just bring them out so that capital, the right capital, can go to the right projects. The right multilaterals can then start working with like-minded infrastructure investors. So I think there's a meeting of minds that still is the need of the hour, what I would say, Jake.
Great, thank you very much, Saad. Hubert, over to you.
Thank you very much, and greetings everybody from Glasgow, where we're immersed in the COP26 discussions, but I think, again, very, very relevant to the points that have been sort of introduced in the opening and of course echoed and built upon by my fellow panelists. Look, I think we're hearing that the next 1,000 unicorns are going to come from green tech, and the opportunity for GPs to reposition themselves to these and other market transformation opportunities, in my view, is very significant in an African market that's going to need in the region of about $3 trillion of investment capital by 2030 for nationally determined contribution projects and transactions, essentially the projects that governments have undertaken and committed to fulfill their commitments within the Paris Agreement. Additionally, we're sort of seeing the fund of funds approach growing in popularity, but we think that that's sort of being overtaken, at least in discussion terms, by the whole structures around permanent capital vehicles for infrastructure, particularly like the ones used by IFM investors in Australia, this is becoming, a real discussion, particularly between asset owners and some of the forward-looking GPs. So we're seeing players on the continent doing this more and more as a strategy to address the climate crisis. And we think that the climate crisis is the opportunity, compounded and coupled with the sort of post-pandemic economic response and strategy. We think this represents an opportunity for forward-looking GPs to really reposition their offering in this respect. And I think that's going to become a growing and increasing trend. We're also seeing that asset owners will also be asking GPs, and this is a big conversation that's happening right here in Glasgow right now, where the asset owners are increasingly being looked at to drive and play a leadership role in the infrastructure space, particularly green infrastructure. So we anticipate that GPs are increasingly going to be asked to decarbonize their portfolios and effectively address Scope 1 and Scope 2 emissions commitment. And that's where a lot of the companies and the investors are taking this conversation at the moment. But we know that decarbonize our own portfolio, decarbonize our own supply chain is, yes, Scope 1 and Scope 2, but combined, that only really addresses about 30% of the emissions challenge that we actually have. But LPs, are increasingly looking to reward, exceptional GPs, and there's an expectation that will grow that GPs could become the instrument for LPs to decarbonize not only their own portfolios, but also the real economy, which is that elusive Scope 3, which effectively is about 70% of the need. So we believe that those ambitious GPs, well placed to articulate how they can address Scope 3 type commitments, that the ecosystem and corporate value chain wide, ecosystems are really going to be focused on, could potentially be in a position to receive larger mandates and larger allocations. So perhaps I think I'll just stop there wearing my quasi-Glasgow hat.
Well, it's great. It's great to have you. And sorry, I didn't realize you moved from Johannesburg to Glasgow, but great to have you from there. I'm actually going to come back to you in a second on, I think, just the point of mobilizing the asset owners and what's maybe the right relationship with the MDBs. I think just to maybe echo a few of the points that my fellow panelists made. One, so we are primarily an advisory firm, but we manage a couple specialized investment vehicles in distributed renewables, one doing commercial and industrial solar in Africa, one doing mini grids. And so I think this trend towards specialization as a way to differentiate is a real one. I think another one is sort of dividing up sort of the operating company risk and the development company risk from the asset company risk. So we exited our first CrossBoundary Energy, which was a commercial industrial vehicle during the pandemic at a 15% net IRR, so what we felt was a good return, but switched out of a GP-LP structure into now an asset company, management company structure that has more essentially unlimited runway in terms of how long we might need to hold these assets. I think another thing is this increased focus on the quality of the pipeline. So IFC calls it upstream. Some of the development agencies might call it investment facilitation, but just this idea that you do need more technical transaction assistance type dollars available to prep projects, or potentially for some of these projects on the government side to sort of build the capacity of the counterparty to feel like they're well equipped to negotiate a fair deal. And I think on the topic of fairness, there's also what is the appropriate role of subsidy? I think, for example, maybe in rural mini grids, there hasn't been enough subsidy available to make what is, fundamentally a tough economic proposition work. But then you also, see situations where governments feel that they've been taken advantage of, and sort of infrastructure owners are making outsized returns and trying to find, the right mix of the catalytic additional capital that's not overly rewarding. In my personal view, I think you have to take, you have to accept that you might see some excess profits in order to incent some of those pioneer transactions that open up the space. So maybe leave it there for sort of the opening landscape question, but I think one of the key issues is around what is the appropriate role of the DFIs, of the MDBs in this capital, and how do we attract more institutional capital in this space? So maybe Hubert, back to you on that question.
Yeah, thank you. Thanks very much, Jake. I think, look, the bottom line that we're sort of seeing and in the market is, we have to look forward. And as you rightfully say, we don't need to keep going to conferences to hear about the unbankable and uninvestable pipeline when all the players have the tools and the capacity to fix that particular challenge. So the bottom line for us really is that we feel that there needs to, we ultimately as the community need to design and deliver greater public-private finance mandate alignment, and then more obviously catalytic private investment pathways that fast track and scale private capital's participation in this particular green transition as the way forward. And we think that should actually be done through a new mechanism called an institutional investor public partnership, very similar to the way that the Australian successful infrastructure investors apply themselves and apply long-term institutional capital. They actually call it PPPs, pensions a public partnership. But on the continent, we're coming at this as a collective of institutional investors, both pension funds as well as sovereign funds. So we call that an institutional investor public partnership. And one of the major ones that we're leading with the African Union and a group of African as well as global institutional investors is the African Green Infrastructure Investment Bank as a platform that will really be focusing on, delivering green and profitable transactions as opposed to green and not profitable, as opposed to just, taking the development side. So ultimately, we just really believe that we need to design innovative platforms that can mobilize capital at scale and deploy capital at speed. And it's a whole sort of new thinking and new approach as we reinvent the future economy and address all of the sort of, the transition opportunities that are there. And we really must see them as a serious opportunity. But we hear a lot from our colleagues in the LP space that, there needs to be a different way to sell infrastructure risk. I mean, we're currently sort of hearing repeatedly that, GPs are more, more in line with selling developmental risks to financial investors, and there seems to be that mismatch. So we really need to create that pathway and that alignment that I mentioned in terms of that institutional investor public partnership type model, and borrow the best practice from the Australian and the Canadian successful long-term institutional infrastructure investors. I think that could work quite well considering the size and scale of the pools of capital we're seeking to mobilize and the ever-increasing and ballooning infrastructure deficit that we have that needs private capital on the continent. So we're basically seeing LPs increasingly investigate their own mandates and investment policy statements, just see in the very first instance whether they can actually address infrastructure and which bucket that comes under, and whether there's a regional allocation, whether a carve-out exists or should exist. And so I think these things are pretty important. And on the MDB side, I think that there's an opportunity to really, again, build that sort of bridge, if you like, in light of COVID-19 and the climate emergency, to basically seize the moment for this sort of wholesale review of additionality models, because we need future-proof models that crowd in, rather than crowd out private capital. So we think that basically, this is the time now where we can take a dual approach, to addressing the post-pandemic economic recovery from an infrastructure standpoint, as well as address the transition. And we know that MDBs are mandated to take the types of risks that we can't take as private capital. And we think that there's some very specific things that they can do. For example, and we think asset recycling, a lot of infrastructure assets are held currently by, regional development banks, MDBs, and development finance institutions. We think a lot of that should be recycled and refinanced and sold down to institutional investors. And then, let MDBs take that opportunity and reinvest those market returns in creating a secondary market for African infrastructure, which is another key and critical component. And I'll just end by just addressing this issue about we all need to work together. And so I think the data is key. And I think a key part of the MDB's role is to really optimize their balance sheets to be able to mobilize private capital. That's part of the Hamburg principles that were undertaken and agreed to. And we know that there have been some challenges of course, including COVID, that have made that not as fulfilling as everyone would have hoped. But in terms of collaboration, we really need to share data. We almost come from the space where we actually think data is infrastructure because it's so powerful in terms of the role that it can play to actually unlock financing. So we know that the GEMS database is a major issue for us, because institutional investors really need the same clarity and transparency of data that MDBs have. And the MDBs have this database called the GEMS database, which basically brings together all of the historic performance of project finance, loans, and infrastructure financings. And that data is only available to the MDBs. So we think that that data should be democratized, and we think if that data becomes more freely and transparently available to institutional capital, we'll see a lot more investment flow. And that's a case that's been proven by the African Development Bank's $1.2 billion Room to Run program, the securitization, where on a special case basis, that data, the GEMS data, was made available to pension funds, and they closed that transaction with record levels of participation from institutional capital. So I think the tools are there, the opportunity and the incentive is there. I just think we need to reinvent not only the market that we need in terms of new transactions, but we need to understand that if the market is going to transform and change so dramatically, so must our own institutions and our policies and our practices and our approaches. And I think it's got to be focused on being able to mobilize capital at scale and to be able to create an enabling legal and regulatory environment that enables us not to have to wait 10 years or 8 or 5 or 7 years for a project to reach financial close. Therefore, we have to create an environment where we can deploy capital at speed. And this is something that institutional investors are very clear on. They say, if you want to see more private capital come into the continent, then let's see more projects reach financial close at a greater pace. And then we can have a lot more confidence in the asset class. So perhaps I'll leave it there. Thank you.
Yeah, thanks a lot there. And I'm going to have to come to you, Ryan, because I think a lot of that, there is a lot of reference to sort of the DFI landscape there and this tension between the DFI as an investor and obviously trying to step in to fill a gap when maybe some investors have stepped back, but the DFI as a mobilizer or enabler of capital, the right bridge to institutional capital, the role of creating a secondary market of perhaps offloading some of your now brownfield exposure to institutional investors. So I guess welcome your comments and thoughts on that.
Thanks. I think Hubert touched on quite a bit there. And I think the collaboration or cooperation amongst investors is really something that needs to happen more than it has in the past. I think DFIs and multilaterals have had this notion that you put money into an investment, you make it seem attractive that you're validating it, and hopefully others come around and invest as well. And this is true in terms of funds, this is true in terms of particular areas or themes in the market. And I think that notion of trying to demonstrate that commercial returns can be had hasn't really come through, and it takes too long to demonstrate even if it can be demonstrated. So I think this idea that DFIs can play a role linking the public markets or the public sector to private markets, it just needs to happen a bit more fluidly. And there's a lot of programs and a lot of things that are going on that just aren't really linked. And I think DFIs can play a better role in trying to link those. For example, at COP, CDC is announcing this partnership with Rockefeller Foundation called Global Energy Alliance, and it's for mini-grids, CNI, primarily focused on Nigeria and DRC. So the intent there is to use concessional capital or risk capital that DFIs can really take, or foundations or impact investors can really take, to try to mobilize $1 billion into those particular niche markets. So it's something like that that we think is really needed much more in scale to get private capital to work and to kind of do it all in unison, or a bit more designed to really be fluid and to really work together.
Yeah, and I guess in those projects, is there how directly will CDC be, the fund manager, so to speak, the developer in some certain cases, or will it be investing through other GPs?
I think probably it'll mainly be, I mean, this is new, this is just announced and developed Rockefeller is leading this.
Yeah.
But I think it will be in a number of different areas. I think it will be through funds and fund managers. It will be perhaps on the lending side. I think we can lend at attractive sort of concessional rates. We don't want to distort the market, but I think we can offer something there that helps to get projects underway. I think in some of these markets it will take kind of niche specialists, and to the point earlier made, I think we will rely on local developers and people that have knowledge in the markets. And I think some of this we really, as a DFI, can't do on our own, so we will rely on others.
Great.
Jake,
Mari, I
can
know you
just
spent a
come
lot of
back-
time thinking about how to sort of change the risk-return balance or calculation for institutional capital. So thoughts on that and what Hubert said earlier?
Yeah, I think I'm gonna echo a lot of what's been said already, but in terms of sort of how do you shift that risk return calculation for investors, and especially if you're trying to bring new investors into the continent. I think one is what we've spoken before is how do you bring de-risking mechanisms and guarantees to change that risk return perception, right? So guarantees won't make a bad project a good project, but they are going to have that catalytic role in terms of changing the risk perception, reducing the cost for the issuer, and attracting new pools of capital. So it's thinking a little bit like a recipe book for someone who never cooked before, or someone who's cooking a complex meal. If you're doing it for the first time, you're going to need that book, and then afterwards you can do it without it, and you can add spice and you can start innovating. And then the second one is TA, so technical assistance. I don't, as I said, I mean, a guarantee won't make a bad project a good project, and to the point earlier, how do you improve the investability of that project? You might need sort of that technical assistance to come in and help improve bankability, but also link those projects to the investors that are out there, to Rupert's point. And then the third is, I mean, the data point I think is a great one in terms of bringing those investors in, and we've been doing some work in the credit rating space in the continent, and essentially looking at is there a potential, is there room for improvements in how global credit rating agencies are assessing risk in the continent? And just as a data point, there are currently 32 sovereigns rated in the continent. More than half of them, 18, are single B rated. So if you're a first-time investor in the continent, and you're looking into 18 countries that are the same, how do you differentiate, right? So to the cooking point again, if you're cooking for the first, you never cooked rice before, so you're looking at basmati and long grain. What's the difference, right? So how do you improve that granularity, that data granularity, and both in terms of is there potential for rating agencies to become better at assessing that risk, but then also how do you bring local actors or regional credit rating agencies that are in the continent to provide that data, because they have it, right? So how do you make that data get to the investors?
Yeah, that makes a lot of sense, and I think there is a role probably for multilaterals in sort of unlocking some of that data and being an honest broker that can push for the release of some of that data. Saad, just to come to you, I mean, a lot of the implied conversation has been around, I think probably, we're mostly thinking in our head of like sort of energy infrastructure projects, transport projects, but I think, COVID has revealed this dimension of health and the social infrastructure as very much infrastructure as well, and I know that's an area where you've invested, so maybe comment on like the full spectrum of infrastructure as well.
No, absolutely. And healthcare has been kind of a key focus for us. I think 40+% of our portfolio is healthcare, from manufacturing down to distribution and retail as well. So we understand that space, and in some cases we have mitigated those risks through guarantees, etc. But one of the things that we've identified is that Hubert mentioned is that asset churn. That doesn't really happen. So banks would sit on an asset that is not performing, but just hold it on their books, not provision for it, and just find ways of kind of delaying that. And we're finding ways of taking those assets off of their balance sheets into another vehicle, for example, and trying to kind of recapitalize it and at least bring it back into, breathe life back into that asset or project, be it healthcare, be it education, be it kind of average infrastructure projects like energy or even logistics. So that's an area. And then the other thing that we've looked at is dollars going into the country can sometimes be a detriment to infrastructure projects. One, the yield's not going to be that high. How is dollarized return going to be achieved? So then partnering with local asset managers, kind of galvanizing that capital that is available in the infrastructure space or available for the infrastructure space, which happens to be in the kind of pension administrators kind of realm. So why don't you leverage that and kind of get that out into the private sector? So again, there's a partnership that we're developing in Nigeria for that, local currency, infrastructure, and that infrastructure definition for pension administrators is very wide. So you can do anything from payment rails platform to a telco or rural telephony project. So it's very, very wide, including healthcare, etc. So I think this is kind of an evolution of this industry, that if this asset churn kind of gets mobilized, it'll be private capital, it'll be institutional capital, it'll be kind of multilaterals themselves. There's churn in the industry, so if private capital takes over, then they've got a secondary market to sell that asset down into. So developing that secondary is, I think, a big problem for PEs, but also for infrastructure managers. So at some point, that market needs to be mobilized and kind of added capital into. Whether that's DFIs or institutional capital, I think that debate kind of continues, but that needs to happen. And if you look at projects that sometimes don't get funding, are very kind of social impactful projects, like education projects. There's a school operator out of South Africa that is now in Kenya and Tanzania, but can't mobilize that much capital. It's got 13 institutions, but funny enough, DFIs tend to shy away from school projects or education projects because of the detriment associated with them or the damage that it could cause. So again, that kind of treading on eggshells needs to be looked at a little bit and frowned less upon to mobilize capital, because what is worse, that education project going under, which means over 3,000 students not having a school to go to, or whether there being a slight, kind of in the news, kind of situation, which is worse, which is a worse evil, I guess, is the question. So that's kind of my kind of value add here, or my kind of perception that across the spectrum, look at whatever aspect of the infrastructure, there is that mobilization, the depth of that market that needs to be created. And without that, unfortunately, we'll see the demise of GPs at the rate that we're seeing in private equity. So I think we collectively, as a capital body, be it institutional, be it DFIs, be it private, just need to come together. And Hubert mentioned this, and perhaps I did as well. So I think, in my view, that's really the need of the hour.
Yeah, I think there's a need perhaps for some openness to restructuring, to rethinking. There are a number of zombie funds or projects out there, perhaps that, and that was tolerated during the pandemic period because you wanted to give things a chance. But I think there is a need to be realistic and also create space for new entrants to come in for like that sort of creative destruction from which then can emerge new projects. I think we're out of time. I see we have the next panel ready in the back, but so hopefully we can engage in some of the sidebars. This is an exciting new event, and it's been just Zoom for the last 2 years, and now we can actually have some of the coffee chats that we've missed. But thanks very much for your time and attention, and please join me in thanking our panel.